Good morning, everybody. Welcome to this, our first sort of dialogue in our alternative assets series, or alternative assets online dialogue series. And today we're speaking about alternative assets. So today's dialogue, as well as the next 4 or 5 dialogues, are proudly sponsored / funded by Fairtree Asset Management, who have sort of, or who are sponsoring this next round of dialogues. I actually see quite a few faces or a few names that I do not recognize. So we are very, very happy. If this is your first time attending our Atleha online dialogues, welcome. We are very happy to have you here with us. And if you are a regular attendee, welcome back. We're also happy to have you here. So I'm Sefako Mative. I am basically the sort of organizer / your host for today. I work for Six Capitals Advisory, which is the implementing partner for Atleha-edu, which is the company that is making these workshops that we have or dialogues that we have possible. I'll explain what Atleha is about to the newcomers a little later. But currently I'm just kind of saying hello and welcome. I hope everybody's good, and I hope you're as excited as we are to do a little learning and a little discourse on today's theme, which is alternative assets. Adrian will take you through the agenda in a few minutes, but for now, we'll just sort of run through we'll introduce ourselves and just say hi and get to know each other. So I'll start. Well, I already have started a little bit. Like I said, I'm Sefako Mative, and I work again at Six Capitals Advisory, which is sort of the implementing partner to Atleha-edu. I do sort of the organizing. Most of you would know me because I'm the one that's in contact with you most of the time. I'm trying to get you to join the workshops, assisting you with, any other queries that you might have. But I also help generate some of the content that Atleha creates, as well as help distribute it, as well as a few other things, conducting research, writing articles. But yeah, nothing too fancy. Yeah, so I'm very happy to have you here. And yeah, that's all, I guess, for now. I'll give Adrian a chance, Adrian, who's my colleague, to introduce himself, and then we will get to everybody else. Hi, Adrian.
Hi, Safaku. Thank you very much. Thanks, everyone, for joining us for this Atleha-edu online dialogue. Again, we're very grateful to Fairtree Asset Management for funding this dialogue series. And Safaku will be explaining shortly around some of the content that Fairtree has previously funded. And we're also busy updating new content that will be going live and be distributed to folk within the month of August. Yeah, as Safaku mentioned, I'm Adrian Bertrand. Safaku and I work together in Six Capitals Advisory. We're a team of about 6 people, and we really do enjoy these opportunities to kind of have these discussions and online dialogues. We also run in-person workshops, which some of you may have been able to attend. And we hope that funding dependent, we'll be able to run a few more of those workshops before the end of the year. So thank you very much for joining us, and we're looking forward to getting to know you as well during today's dialogue. Thanks, Safaku.
Thank you very much, Adrian. We'll be hearing from Adrian shortly, but now it's everyone else's turn. So hi, let us know, you can just introduce yourself shortly, maybe with your name, surname, where you're from, what union you represent, and maybe just a little bit on why you decided to join us for today, or maybe what you're hoping to learn from today's dialogue, or what you'd like to discuss. So I'm just gonna read out the names as they appear on my list. So the first person on my list is Lorraine, who I don't believe I've met before. Good morning, Lorraine. Can you hear me? Or can I hear you? Because I see your mic is on, but I can't hear anything. Or is it just me? Can anyone else hear Lorraine?
No, not at the moment.
Okay, I'll give Lorraine a chance, maybe she's actually not speaking, but her thingy is on. But I see also Xolile has been connecting to audio for a while, so I'm maybe just gonna give her a chance to be properly settled before letting her speak. So I'll move on to the next person on my list, who is Shirley. Good morning, Shirley. How are you?
Good morning, everyone. And how are you doing today?
We are doing very well. How are you doing?
I'm doing well as well. My name is Shirley Khapula. I am from Dinosa in Pumalanga. My intention to join this workshop today, this dialogue today, is to get more information about the alternative assets. Thank you.
Thank you, Shirley. I'm hoping we'll be able to provide that information with you. I see in the chat that Lorraine can hear us. It's just that we can't hear you for some strange reason. Hopefully that'll get fixed. But if not, at least we know that you can hear us. Maybe just in the interim, maybe you can just type in your introduction, and then maybe later the mic will work or something. You know, technology is always disappointing us when we need it the most. So I'll move on. The next person on my list is Nomsombuluko. Good morning. How are you?
Hey, good morning, all. How are you?
I am
I don't
very
know.
good.
Oh, you can hear me.
Yes, we can hear you.
Okay. I'm here and thank you for inviting us once more. Last time I learned a lot on the workshop that we had at Radisson Hotel. In fact, I was scared when I realized that we are not safe when we are doing things in the near future with our pensions and stuff. So I'm hoping to gain more knowledge because this workshop doesn't only help us on the professional level as shop stewards, but it also assists us in our lives and how to assist other people who are not privy to these workshops as to how do they save, how do they conduct their financial affairs in case we are no longer on this planet. That's me.
Well, thank you. I'm glad that you enjoyed our workshop. I remember you. We had fun. It was nice to meet you then, and I'm glad that you derived value enough to come join us again because there's always more to learn. You never sort of run out of things to learn. So I'm glad that you are, you know, still intending. Before I move on to the next person, Lorraine has actually sent her intro in the chat, so I will read it for us all. So she says, okay, I'm Lorraine Shitiba from Basel, read in Venetia Mine, which is in Limpopo. Welcome, Lorraine. There's also a second text that she sent, which is my intention or reason of joining is I'd love to get information about alternative assets and knowledge. Yeah, so we have, you know, Adrian is something of an expert. So hopefully he'll be able to share and help you gain that knowledge that you are seeking. And she is under NUM as a shop steward, serving as the education structure or serving on the education structure as a secretary. I wonder if you attended one of the two workshops that we had either in November last year or in March this year, because we've obviously met with some of the NUM delegates. So I'm wondering if you were there and I just, oh, it's your first time. Okay, hopefully not the last. I hope you get everything that you've been looking for in these sessions. The last person on my list currently is Lina. Good morning, Lina.
Good morning, Sifago and the team. Thank you very
How are
much
you?
once again. Hello, I'm very well, and how are you? Thank you very much once again for hosting us in a Women's Month. I'm happy the majority of people that I had in this dialogue today are females, but nonetheless, that is on the lighter note. Like all other times, we always anticipate to learn and get more information about things that are affecting our lives directly and indirectly. So as worker leaders, we appreciate all the informative workshops that you are giving us, or dialogues. Thank you.
Thank you, Lina. And thank you for the reminder. I can't believe I forgot. Yeah, happy Women's Month, everybody. I'm also quite happy that we are well represented today by our women leaders. So it's very exciting, and I hope, you know, it would have been great if we had a woman leader also to present to you, but unfortunately it's just myself and Adrian. So you'll just have to make do. Next Women's Month, we'll make sure. But yeah, we are very happy to have everybody here. Yeah, so let's use this as an opportunity to learn, to talk, to engage. So if you have any questions, if you have any comments that you'd like to make, please at any time feel free to raise your hand, or just like Lorraine, just send your comments or questions in the chat. I'm looking at everything, so I'll definitely give you the platform to speak. Yeah, so hopefully we have a good day today. I'm quite happy with sort of the turnout, and I'm hoping that we'll still have more of our cadres joining us. I'll be looking for them while Adrian sort of presents on the agenda, and also while he presents. So yeah, without further ado, I'll give Adrian the chance to just go through today's agenda. Take it away, Adrian.
Thanks very much, Safaku. Let me just start my video. There we go. And yes, from my side, a very happy Women's Month to our women worker leaders. It's great to have you participating today. And yeah, there's nothing better than empowering ourselves through education. We're a small group, so it means that we can ask questions and we can make comments. So please feel free to follow the comments or questions. You can either post those questions in the comment section or the chat function, but you're also welcome just to unmute yourself, and you can put your camera on if you like to ask your question while we are presenting and in discussion. We really do want this to be interactive. So you'll see from the agenda on the screen, Safaku's already spoken about just provided the formal welcome and the introduction. I'm going to ask Safaku shortly to provide us with a little bit of an overview of Atleha-edu and what we are seeking to do as Atleha-edu when it comes to educational content. And then I'm going to present on an infographic on alternative assets to introduce the topic. We'll have some question and answer time, so you'll be able to ask your questions after I've presented. And if you really have any burning questions, you're welcome to ask those questions while I'm presenting. We are only going to skim the surface of alternative investments or alternative assets in this short session today. So we'd encourage you to sign up for a full day or a half-day workshop, which the ASISA Academy offers. And in the chat function, I've included the link to the ASISA Academy Retirement Fund Trustee Education Workshops, and we'd encourage you to sign up for other workshops on similar educational themes. So please do have a look at what the ASISA Academy offers. They're also one of our project partners with Atleha-edu. And also to mention that we have got quite an exciting lineup for you, also funded by Fairtree Asset Management. So we have another session in 2 weeks' time, which will be on the 16th of August. That's going to be on private equity, which is another category of investments under the alternative assets banner. On the 8th of September, we'll be looking at hedge funds. On the 13th of September, we'll be looking at commodities. And then on the 27th of September, which is my birthday, we'll be looking at trustee duties and responsibility. So that's our program between August and the end of September, and we really do hope that you will be able to join us And we also hope that you will be able to invite some of your other colleagues and comrades to also join us for these sessions. As you might have seen from our previously scheduled sessions, we record the sessions and then we are able to distribute the Zoom recording with all of our organized labor colleagues. So this session is being recorded and we'll be able to share the content with each of you as well as with those others in our organized labor database. So with that, Safaka, I think I'm going to ask you to take us through the pre-workshop M&E kind of questions, and then also to explain what Atleha-edu does. Thank you, Safaku.
Thank you, Adrian. So I think I will take us through Atleha first, and then I'll run the M&E. So I'll just quickly explain what Atleha-edu is about to those who are joining us for the first time, like Lorraine. So Atleha-edu basically is a not-for-profit company which has the aim or the objective of basically educating and empowering stakeholders within the retirement fund industry about all things related to their retirement so that they can retire comfortably with dignity, but also in the structures that they hold as leaders, as shop stewards, as trustees. It's also the aim of Atleha-edu is to empower you guys so that you can also empower your constituents. And how we do this is through two sort of broad ways. We do it through awareness content as well as through interactive education. So interactive education would be things like this dialogue that we have, or even the in-person workshops that some of you have attended, most of you would have attended. And this is just, to help educate and empower you so that, again, you can educate and empower those that you are responsible for. So yeah, the majority of our awareness content, which I will try and show you now. Let me share my screen first. I need to find, oh, there we go. Yeah, so our awareness content basically is mostly found on the Atleha-edu website. Can you see my screen? Let's start there. Yes, okay. So this is the Atleha-edu website. You would simply just type in atleha-edu.org and it will lead you to this page. And we, once again, like I've mentioned, we create all sorts of awareness content. We create 20 to 22 page publications, of which cover specific themes within, or specific themes that we feel are relevant to the retirement fund industry or to the stakeholders. So today's topic is on alternative assets. And this is part of sort of the second phase of a project that we had initially done with Fairtree Asset Management, who's also the sponsor of today's dialogue. But the previous publication that we had done with Fairtree Asset Management was this one, which was the alternative asset classes, understanding hedge funds. So we're currently in the process of doing sort of an almost second version of this, where we delve deeper into all the other asset classes. That publication should be coming out in the next 1 or 2 months. So keep your eyes on that. But so this is the type of content that we would make, that we would also share with you guys. So most of you would be receiving emails from Atleha-edu on most Fridays. Every time we sort of have a new piece of content, we share it. So we don't only make education publications, we also have short articles. So some of the themes that we cover within our publications, we will also convert into short articles. So for example, the alternative assets publication that we did produced 1, 2, 3, 4, 5, 6 short articles. So we would take articles within that publication and just, hone in or zone in on one specific theme. So in the case of the alternative assets theme, we did one on just an overview of hedge funds, some of the hedge fund strategies that are employed, what hedge fund managers do, how hedge funds are regulated, as well as just the role of management companies, as well as, you know, just a standard frequently asked questions article on some of the questions that a lot of people that are looking to invest in hedge funds would ask. And then we've had obviously other short articles that we've also produced since then. But then we also have sort of infographics, which we try to summarize the most important parts of whatever the content is that we're trying to create. So part of, or a large part of Adrian's presentation today will be on this particular infographic. So this you can find on the website, and it will just, you know, basically the infographic is there as a sort of short summary, and it has cute little pictures and colors, which can help which can help you with just memorizing or just knowing the key things about whatever it is, whatever the subject is that we were talking about, whatever the theme is that the infographic falls under. We also create sound bits, and these are basically the short articles being read aloud. In some of the instances, we have short articles that are in different languages. And then we would have those short articles also read out in those languages. So we'll have a short article read out in English, excuse me, as well as whatever language that particular short article has been translated into. We didn't actually have any short articles or sound bits for the alternative assets theme for the first phase. Maybe we might have for the second, but we do have others on the retirement fund death benefits, sustainable investing, which are sort of our more later publications or our more recent ones. So you can always give those a listen. And then we have what I think is my favorite part of the content that we make, and these are video bits. So we would take those specific themes and create short animated videos, which would just, again, try to explain some of the key concepts. So as part of the first alternative assets publication, we actually had 4 video bits, one on just explaining sort of asset classes according to Regulation 28, as well as the limits or the investment limits that Regulation 28 places on retirement funds. We had one that just explains what alternative asset classes are, and then obviously a video on hedge funds. So these are really fun. They're very short, like 2 or 3 minutes max. And it's just another way, you know, to help disseminate the information, because we do understand that people learn differently. So some people memorize things better by reading. Others, you know, they learn things easier by having someone speak to them, and others learn even better by, you know, visual aids, so like videos and infographics. So we're really trying to, you know, make education as accessible as we possibly can. And obviously the nice thing about Atleha-edu is all the content that we generate, all the workshops, everything that has Atleha's name on it, that you know, that you receive from us is entirely free to you as the constituents or as the stakeholders. We get our funders, for example, in today's series is funded by Fairtree. So they would fund us, or they would fund Atleha, and then Atleha would use those funds to educate you guys. So it's entirely free, which means you can also share it with anyone and everyone. We encourage you to do so, because obviously not everyone can, not everybody can be present in these dialogues. So it's nice that there's actually a platform where some of the content that we discuss is actually available for you to share. It's also there to supplement the things that you learn in the dialogues. So, you know, use this site, share it, and just, you know, go wild. But also, if you want to sign people up, or you want people to also become regular receivers of Atleha-edu content, you would just come here to the sign up tab on the top part of the website, and it will lead you to this little sign up form. It's a quick fill out, probably 5 minutes. And then once we have all your details or the details of whoever you're trying to sign up, then they will also start receiving the content that you are receiving. Yeah, that's all basically on Atleha-edu. If anybody has questions, have I not been sharing my screen? I feel like it's not, oh, it is sharing. Yeah. So if anyone has any questions on just what Atleha-edu is about, or you'd like to explore something or find out more information, you can always text me or email me or Adrian, and we'll be happy to help. You can also call us. Yeah, so that's it for the sort of introduction to Atleha. Yeah, I'm just gonna hand over to Adrian now to present. Adrian?
Thanks, Safaku. Really appreciate you running with the quiz. And yeah, for those of you that might not have felt so confident around some of those questions, the good news is that, yeah, hopefully after our kind of looking at the content that we're going to be presenting today, you'll feel a lot more confident around some of those questions. So Falco, can I just confirm that you can see my screen? Can you see the infographic, alternative assets?
Yes.
Okay, great. And colleagues, we're going to be using this infographic as our main kind of supporting document for today's online dialogue. I have in the chat function shared the link to the various Atleha-edu content pieces that have been generously funded by Fairtree Asset Management. Please do, after the session, take some time to work through the various pieces of content which have been shared with you. So you can have a look at this infographic in more detail. You can read the 20-page publication on alternative investing. There are the animated videos that you can view. There's audio clips. There's short articles. There really is a lot of additional resources that you can look at. And then a reminder that you can actually sign up at no cost to also do a longer workshop through the ASISA Academy. And they offer workshops on themes such as infrastructure or private equity, hedge funds. And if you'd like to go into the content in more detail, the ASISA Academy link to their various workshops that are on offer has also been provided in the chat function, and you can go and have a look at the course content for each of those workshops. So today we're going to be talking about alternative assets or alternative asset classes. And as the name says, it's about an alternative or not the usual type of investment. So this will, generally speaking, make up a smaller portion of your investment portfolio, specifically if you are a retirement fund. And this infographic we produced, I think, earlier this year or late last year. There's been 1 or 2 changes that have been introduced by the updated Regulation 28 of the Pension Funds Act, which took place last month on the 4th of July. And so as a result, there are some changes that we'll be making to this infographic to bring it up to date, given the very recent changes announced with the gazetting of the final version of the revised Regulation 28. So at its simplest form, what is an alternative asset? An alternative asset is any asset that does not fall into your conventional investment categories, such as equities, and specifically listed equity or listed shares of well-known companies that are listed on a stock exchange, bonds, or fixed income instruments or investments that are made available to retirement fund investors, and then of course cash, which is money in the bank which we're all familiar with. So the three forms of alternative assets that we'll be looking at in today's online dialogue are private equity, hedge funds, and infrastructure. Now, all three of these fall under the category of alternative assets or alternative investments because they fall outside of the traditional asset classes, which are cash, bonds or fixed income, and listed equity or listed shares. That being said, in some funds that are developed, there is a mixing or a blending of different types of instruments or types of investment. And so you might invest in a private equity fund that might use forms of equity and debt when it is investing on your behalf. But for the most part, it would be investing in unlisted or privately held companies, which offers shares to a limited number of investors. So we've discussed or covered that alternative assets are your non-traditional assets or opportunities for investing. Why would a retirement fund want to invest in alternative assets? Well, the main reason for that is that alternative investments offer investors the opportunity to generate optimal risk-adjusted returns. So we're all familiar with the saying that you shouldn't put all of your eggs in one basket, because of course, if you drop a basket full of eggs, you're likely to have lots of eggs that get broken, and somebody will go without breakfast. Now, in the investment world, you don't want to put all of your investment eggs in one basket. You want to have a diversified investment portfolio. You want to avoid what some people call concentration risk, where you don't want to have all of your eggs in one basket or in one asset class. And so that's why one needs to split your portfolio into your traditional as well as non-traditional or alternative investment options. And different types or categories of investments will have different risk profiles, or they will have different levels of risk. They will also have different levels of return, because when an investor takes risk, they expect to be incentivized for taking on that additional risk with hopefully improved investment performance or outperformance against safer, more traditional investments. And there are also other aspects to consider when you invest in alternatives, such as private equity and infrastructure investing specifically requires investors to commit for a longer term investment than, for example, a listed equity investment, which you can sell in, you can buy and you can sell quite quickly. So if you wanted to invest in Sasol or MTN shares, there would be nothing stopping you as an individual investor from buying that share in the morning and selling that very same share in the afternoon. You can do it almost instantaneously. You can buy the share and you can sell the share. If you are going to be investing in a private equity fund, or you're going to be investing in an infrastructure investment, you are going to be stuck in that investment for a period of time. In a traditional private equity fund, your commitment period is anything from 8 to 12, 15 years. So you would have to wait for between 10 to 15 years before you could get your investment returns or get your money back. The same for infrastructure investments. If you think about investing in a road or in an airport or in a harbor, a port facility, those investment horizons are very long term. And so your money is held up within those investments because of the long-term nature of those assets. So if you are needing to get your money quickly, and if you're a retirement fund, the main reason that you would need to be able to access your money for a portion of your investment portfolio is in order for you to pay a retirement fund benefit or a pension that somebody needs to access on a monthly basis once they've retired from active employment. Or it could be because somebody has left the employer organization and wants to move their funds with them. And so it is appropriate to have some part of your investment portfolio as a retirement fund allocated to more long-term investments, because by nature retirement funds are long-term investors. But you cannot have 100% of your retirement fund tied up in long-term investments, because you do need to be able to access your investments in order to pay pensions or to pay benefits. It's a bit like your own savings or a bank account. You could take all of your money and put it into a 30-day or a 60-day or a 90-day fixed interest deposit, but you are getting a benefit of a higher interest rate because you are locking that money away for a period of time. But we all know that we need to be able to access our money in the bank to pay our bills, to pay rent, to pay the car, to pay insurance. And so it would be foolish for us to commit all of our money into a fixed kind of deposit, which is locked away for 30, 60, 90, or even longer days or months. And so in the same manner, a retirement fund needs to be careful around how it allocates its investments across these different types of assets. So alternative assets are there to either beat the returns, to give you a higher rate of return than a traditional type of asset. So private equity, for example, as opposed to listed equity, it's privately held. You don't have as much information available in the public domain. You are locked in for a longer period for the investment. And so generally speaking, private equity investments need to outperform listed equity investment opportunities, because private equity investors need to incentivize retirement funds or other investors to commit for a longer time period when they invest in private equity. So they need to offer a more attractive investment return to make up for some of the other constraints, such as being locked into the investment for a longer time horizon. It could also be seen as a way to reduce risk compared to a more traditional type of investment. And here, infrastructure investments might be a good example of how one can reduce risk. So when you invest in an infrastructure investment, like investing in road infrastructure or railway infrastructure, energy infrastructure, we know how seriously in need our country is of alternative suppliers and generators of electricity, as opposed to just relying on Eskom. In a sense, when you invest in these types of alternative assets, many of them are kind of have a unique competitive advantage in the market. There are sometimes what one calls monopolistic type qualities to these investments. So in the case of power, for example, Eskom has the current monopoly, and independent power producers supply Eskom. So you are, your risk of Eskom not wanting to take your power that you're able to generate and to sell into the grid is quite low, because Eskom is so desperate for additional support when it comes to power generation. The same with SANRAL, the South African National Roads Agency. There are no other competing privately owned road infrastructure businesses competing with SANRAL. And so there's an advantage there that you have this predictability and the stability of investment returns that are available through some of these longer term infrastructure type projects. So you are not valuing these investments on an hourly or daily or monthly basis. They generally get valued once or a year or twice maybe maximum twice a year. And you get your stable kind of revenue payments during the lifetime of the investment. And so there is an incentive to invest in these types of alternative assets. So generally, when you don't invest in a traditional investment, the motivation for that is for either optimal risk-adjusted returns that your traditional asset classes don't offer, and it could even be a higher return to make up for the liquidity constraint, having your money tied up in that alternative investment for a longer period of time, and also potentially because of a perceived higher level of risk, investors want a higher return for taking on a little bit of a higher risk. So focusing now on the three types of alternative asset classes that we'll be discussing in today's dialogue. We have private equity funds, hedge funds, and infrastructure funds. And I'm going to be explaining each one of those in a individual basis. So we'll start with private equity funds. Generally speaking, a private equity fund will invest in a small number of investments, which are privately owned companies that are, for the most part, companies that have been identified as being able to grow and to perform well, and they are attractive from an investment and a growth perspective. The private equity investor generally invests in these types of opportunities through a private equity fund, and that fund will have an investment time horizon of about 10 years. So when the investor invests or commits into the private equity fund, the first few years of the private equities fund life will be spent on making investments on behalf of the investors into the fund. So the first few years will be on acquiring new businesses or buying into new businesses, new privately owned businesses. And then they build those businesses up. And then if it's a 10 or a 12-year fund, as the fund starts approaching the end of the fund life, they now need to start thinking about how are they going to exit or sell out of these investments. So if you think about a private equity fund, perhaps buying into an investment, a privately owned company, perhaps it's a company that is a manufacturer of some form of equipment. They would then want to invest in the company at the early stages of its growth to help it to grow. And then they would need to start thinking of ways to sell the company so that they can use the money that they make from that investment to pay the investors such as yourselves. So before a private equity fund actually makes an investment into a new investment, they already need to be thinking about how they will one day have to sell that investment. And there are various options. They could, for example, list the company on a stock exchange and invite other investors to buy into the investment. And as other investors come into the investment, it allows the private equity fund to sell out of the investment. Sometimes they can sell the investment back to the founder of the business if the founders or the founding team has got enough access to capital to buy the business now that it's grown bigger and more substantial. They could also sell the business to another investor, another private equity fund that may want to take it to the next level of its growth cycle. Or it could also be selling the investment to another player in the broader industry or sector in which that business is operating. So those are some of the things that a private equity fund and the management team of the private equity fund would need to think through before they actually make their first investment into a new entity. Operationally, what tends to happen is you will have what you call general partners and limited partners. The general partner is the fund manager or the asset manager who will be managing the assets on behalf of the investors. The limited partners refer to the investors, specifically retirement fund investors or insurance company investors or high net worth individual investors. And the limited partners trust the active management of the investment to the general partner. The general partner or the asset manager will be charging a management fee, which will vary anything from 1% and 2% per the size of the investment that has been made of the entire private equity fund. So if it is a R1 million fund or a 10 million rand fund, their management fee that will be charged will be 1 to 2% of that R1 million or that 10 million rand of assets under management, or AUM, that is being managed on behalf of the investors. There needs to be some shared risk and return. And so generally what happens is not only is there a management fee of between 1 and 2% charged on the total size of the private equity fund, but when it comes to closing the fund at the end of the fund life, and when they are starting to tally up the financial returns that the private equity fund has been able to achieve for the investors, once the private equity fund or the general partner has demonstrated that they have achieved their financial targets, which were promised to the investors, any money that is made above that minimum return expectation or requirement is then split between the investors and the general partner. So the general partner and the limited partners on an 80-20 split. So 80% of the investment returns above a set required return or investment rate, 80% will go to the limited partner investors, the retirement fund investors, the insurance companies, the high net worth individuals that have invested in that business. And 20% will go to the fund manager or the general partner. And so that's why in private equity, it's a very attractive business for fund managers and people that want to work in asset management, because quite quickly you can become very wealthy. And so the argument, or the thing to make sure of when you are a retirement fund investing in a private equity fund, is to make sure that your return expectations are appropriate for the level of risk that you're taking, that there needs to be an alignment of interest. So it shouldn't only all be in the best interest of the fund manager or the general partner, but it must actually be an attractive investment opportunity. There's alignment of interest. Your investment interests are protected as retirement fund investors investing into private equity investment. Now, I mentioned that Regulation 28 of the Pension Funds Act has been updated last month. It was gazetted, I think, on the 4th or the 5th of July. And private equity in Regulation 28 has actually seen an increase from 10% of your entire portfolio being allowed to be invested in private equity investing or investments to 15%. And we think, or government has done this to incentivize and to motivate for more investment by South African investors, specifically by South African retirement funds, to invest in fund managers and in private equity funds that are going to help grow companies, that are going to help grow South Africa's competitiveness globally. When thinking about our domestic peers and countries, our immediate neighbors, we want to be able to compete with them when it comes to the goods and services that we produce in South Africa. Private equity funds, because these companies are generally on the growth curve, they will be able to result in job creation opportunities and local economic development and socio-economic development. Maybe also worth mentioning is that a lot of private equity funds are now also starting to focus on non-financial metrics and targets, such as job creation, the number of new full-time jobs that they're able to create. And so there is also an area within private equity for impact investing, where investors are investing for a specific financial return, but at the same time, they also want these fund managers to work towards achieving certain socio-economic, such as job creation or environmental positive impacts, or other impact metrics that are of interest and concern to investors. So in a nutshell, that is private equity simplified. As mentioned, Regulation 28 now allows for retirement funds to invest up to 15% of their total investment portfolio into private equity assets. Private equity assets can be from each and every sector of the economy. You'll find private equity funds that invest in financial services companies. You'll find private equity funds that invest in agricultural type businesses. You'll find private equity funds that invest in retail or fast-moving consumer goods. There really is no limit to the sector focus for private equity funds. Moving into hedge funds. So hedge funds, I think, are a little less known than private equity funds. And hedge funds are alternatives, but they can also have both listed equity as well as unlisted equity in their mix as a hedge fund. They can follow both a long and a short approach to investing, and they are probably best compared to collective investment schemes or unit trust vehicles that I think hopefully we're all familiar with. And the hedge fund manager typically operates on a similar model to private equity funds, where you have a kind of an investment manager, and then you have a management company that oversees the investment management process, which is performed by the fund manager. A hedge fund needs to operate under a specific mandate, just like private equity fund. There are some hedge funds that are available for investment by retirement funds, and then there are other types of hedge funds that are seen as a little bit too risky, and they are only available to qualifying investors. Similar to private equity, on the fee structuring for hedge funds, typically hedge fund managers earn a management fee of about 1%, and then there are performance fees similar to private equity, where there is a split in any additional money that is made above a certain financial return requirement, where the fund manager then participates in those returns, and that can be anything between 15 and 20% of any money that is made over and above what they set out to achieve for their clients. That is then split between the investors and the hedge fund manager. Regulation 28, when it was updated last month, did not change the allocation to hedge funds. So private equity and infrastructure saw an increase in the allowable limit for investment into those private equity and infrastructure assets. Hedge funds has remained the same as 10% of capital, but what they have done is they have split out private equity and hedge funds from the same category into different categories with the updated Regulation 28. So if you are a retirement fund in South Africa, you are allowed to invest up to 10% of your total investment portfolio into hedge funds. You're now allowed to invest 15% into private equity funds. And our next asset class type under alternatives is infrastructure. And Regulation 28 for infrastructure has increased the limit to now 45% of your total investment portfolio that can be allocated to infrastructure assets or infrastructure funds. Now, why would the regulator be so positive about infrastructure funds? Well, I'm sure as you can think, infrastructure investing, these types of projects are long-term projects. They are intended to improve the standard of living for a society and a country. They are ways to help kickstart the economy. And you can just think that when a new road is being built or a new power plant, any big new real estate or infrastructure asset that is being built, a new airport, a new hospital, a new school, you can just think of the job creation benefit of that and the local economic development benefit of investing in these types of assets. So it will help with increasing employment opportunities, but at the same time, these are long-term investments that offer a measure of protection against inflation for retirement fund investors. Inflation is a real risk to retirement funds because obviously retirement funds need to pay a monthly pension to their pensioners, and those pensions need to keep pace with inflation. And when you invest in a project like an airport or a toll road or a hospital, the fees that are charged to the ultimate clients or the users of that infrastructure asset are linked or are coupled to inflation, and there will be inflationary increases. And so investing in infrastructure assets for a retirement fund or for an investor with a long time horizon in terms of when they need to pay their obligations to members and pensioners, infrastructure funds can be very attractive because they can help reduce that kind of volatility risk because these are long-term assets and they generally are also able to keep pace with inflation. So there are different ways to access infrastructure investments and infrastructure projects. This can be via both publicly listed vehicles as well as via privately owned or private equity type investment vehicle. It can also be via equity, so shares in a project or a company, or it could be via debt, which is loans that are offered to infrastructure projects or companies that will kind of follow a typical kind of bond or debt repayment approach. And these longer term debt investments or debt commitments are then paid back to investors over a period of time. And when it comes to the ultimate projects that are covered under infrastructure assets, you'll see in the infographic, it talks here about transportation projects, energy projects, communication projects. Just think about the rollout of fiber optic cables for data. I've certainly seen in some of the most rural parts of our country, fiber optic cables are now going to those parts of the country, enabling people to connect to the internet, to enjoy high-speed internet access, which then allows them to work from these rural areas or areas that previously couldn't really compete when it came to access to data and access to the internet, etc. When it comes to investing in infrastructure funds, they can also follow multiple formats, but many in South Africa are unlisted private equity type funds, which are dedicated to investing in infrastructure projects. They will also follow, where it's following a private equity approach, a general partner and a limited partner model, where the ultimate retirement fund investor will be the limited partner and the infrastructure fund manager will be the general partner. And again, the investment time horizon might be longer than a traditional private equity fund, but it will also apply a management fee of a percentage. It might be 1 or 1.5% or less than 1% management fee on the committed capital, the actual size of the investment fund that is charged to investors. And then if there is any outperformance, there will probably also be the 80-20 principle applied, where any returns above a specific requirement rate, 80% will go to the limited partner investors and 20% to the general partner or the fund manager. Infrastructure funds, because they are generally very big funds, you can just imagine the size of investment that is needed in a big railway project or building roads or an airport or a hospital. And so your fees that are charged by infrastructure fund managers are probably a little less than some of your smaller fund-sized private equity fund managers. So as of 3 January of next year, that's when the new Regulation 28 guidelines kick in. They're now published, they're gazetted, they're in play. But from the 3rd of January of next year, retirement funds can use the new Regulation 28 guidance to the maximum effect, which means that you are allowed to then invest up to 45% of your retirement fund portfolio. Remember, this is going to be across multiple asset classes and multiple assets, but you will be able to invest up to 45% of your retirement fund into infrastructure type assets. Regulation 28 is not saying that you have to invest 45%. It's saying that the Board of Trustees needs to decide based on your own membership base, based on your own liabilities in terms of the pension obligations that you have. It's up to the individual Board of Trustees to consider to what extent you would like to explore utilizing that up to 45% limit for investing in infrastructure assets. So it's not a prescribed amount in terms of your portfolio, it's a limit. It's a prudential guideline which says it's probably not wise for you to invest more than 45% into infrastructure assets. And I think the intention is that the bulk of those infrastructure assets need to be in South African infrastructure projects. Also to mention that Regulation 28 also now requires retirement funds to report on the top 20 infrastructure projects into which the retirement funds are invested. So if you are holding and investing in infrastructure assets, in light of Regulation 28, the government or the regulator, the Financial Sector Conduct Authority, wants to understand what are your top 20 investments when it comes to investing in infrastructure. And that's a way for them to monitor to make sure that these investment limits are not breached or overridden by retirement funds. And again, the intention here is to protect retirement fund members from any concentration risk or having too many eggs in one basket. And that's why the regulator is requiring retirement funds to report on these assets. The same for hedge funds and collective investment schemes. There's a new requirement around look-through, being able to show what are the ultimate investments that are being invested in through some of these alternative structures. But we'll cover that in more detail in our next online dialogue. So I think you've heard a lot from me. I'm afraid I've been talking and presenting, so I haven't been following the chat function to see if there are any chats or questions that have come up in the chat function. So let me just have a look. So I don't see any questions or comments in the chat function. So let me invite any questions now, and Safako and I will gladly try and respond to any questions that you might have on alternative assets, specifically what we've covered today being private equity funds, hedge funds, and infrastructure funds. Are there any questions? Happy to hear them. You're welcome to just ask your questions verbally, or if you'd like to, you're welcome to post your questions in the chat function. Are there any questions? There's no such thing as a wrong question or a bad question. Questions are an opportunity for us to clarify whether we've understood things correctly. And yeah, it helps us as the facilitators to also know what perhaps we can cover in more detail at a subsequent workshop. Okay, I'm not seeing any questions coming through. Hopefully that means that the content has been fairly clear and self-explanatory. Thank you very much for joining us today. Are there any kind of final questions or comments that anyone would like to raise before we kind of end the online dialogue here? Maybe just to remind folk about our forthcoming workshops. I just want to change my screen just to advertise the workshops that are coming up again. Okay, so just a reminder about our forthcoming sessions. On the 16th of August, which is in 2 weeks' time, we'll be looking at private equity in more detail. On the 8th of September, we'll be looking at hedge funds in more detail. On the 13th of September, we'll be looking at commodities. And then on the 27th of September, we'll be looking at the duties and responsibilities of trustees. These sessions are recorded. We'll be sharing the recording of the session with yourselves in probably later this week, early next week. And please do invite others to join us for the next round of online sessions. Was it Lorraine or Shirley who had a hand up? Are there any closing
Lorraine,
questions?
Sorry, Adrian. It was Lorraine, but she sent her question in the chat. She says, can we be able to access today's session for a recap? Yes, indeed. Once I've edited the recording, I will share it with everyone. So you'll have your recap. But in the interim, the infographic that Adrian was presenting from is already available on the website. I'll just paste that link again. You can follow that. But yeah, I'll share that hopefully within the next few days.
And also just to note that the infographic that we worked on today, or that we used today, we are working on to update to the most recent Regulation 28, as was announced earlier last month, early in July. So the investment limits remain the same for hedge funds, but private equity has now been increased by 5% to, you can invest up to 15% in private equity assets, and then 45% is the new limit for investing in infrastructure. So Safaku, that's it from me. I'm not sure if you've got any closing remarks.
No, there's nothing. But thank you everyone for attending. Thank you for your attention. If you have any questions or any requests or any comments, you can always text me or email me or call me or email Adrian or call him. But yeah, until next week, see everybody and have a good week.
And again, a big thank you to Fairtree Asset Management for making these online dialogues possible.
Bye,
Thank
everyone.
you. Bye.
Bye-bye.
Thank you all. Take care.